Hey, what's up guys? Welcome to another episode of Real Life CFA. In this series, we're going to talk about all the important concepts in the CFA curriculum. Without further ado, let's get right into it. So the topic for today is Collateralized Debt Obligation, aka CDO. By definition, a CDO is a complex structured finance product that is backed by a pool of loans and other assets and sold to institutional investors. Here's an example how it works. If Ray wants to buy a house and needs to borrow $1 million, and Ray would go to the bank and ask for a mortgage of $1 million. So Ray goes home with that $1 million, and the bank gets the $1 million loan from Ray and makes interest income from Ray of that $1 million loan. Now the bank has two choices. The bank can either hold that loan and keeps making those interest income, or the bank can choose to sell the loan to investors and get the money back. Now CDO is a product created by the banks, and the underlying assets is a pool of those loans. Now back to Ray's mortgage. If the mortgage is sold to investors by the bank, then Ray still pays the bank the monthly payments, but bank will redirect those payments to the investors. So at the end, Ray pays the investors. All the mortgage payments goes to the investors. If Ray gets laid off and stopped paying those mortgage payments, who's the loser here? Is the bank or investors? The answer is the investors, because they are the owner of their mortgage. If Ray defaults, the investor will suffer a loss. What about the bank? After selling the mortgage to the investors, bank bears no risk on this specific loan. Now, why would banks create CDOs and sell them to investors? We'll talk about that later. Now, let's look at the structure of a CDO. A typical CDO is sliced into sections known as tranches, which catch the cash flow of interest and principal payments in sequence based on seniority. If some loans default and the cash collected by the CDO is insufficient to pay all its investors, those in the lowest tranche suffer losses first, meaning all the payments will go to the first tranche and then the second and then third until the last. Because each tranche bears a different level of risk, coupon payments vary by tranche, with the safest tranche receiving the lowest rates and the lowest tranche receiving the highest rates to compensate for a higher default risk. And each of these tranches can be sold separately. As we can see from this graph, each tranche would have a different credit rating, a different yield, a different price, a different coupon. Now, what is a synthetic CDO and why is it important? It is important because synthetic CDO is actually one of the main causes of the 2008 crash. So a synthetic CDO is a variation of a CDO that generally uses credit default swaps and other derivatives to obtain its investment goals. Meaning if you enter a synthetic CDO contract, you're actually not buying a CDO or any loans. You're just entering a paper contract that bets on or against the prices of the CDOs. A synthetic CDO is typically negotiated between two or more parties that have different viewpoints about what will ultimately happen with respect to underlying reference securities, in this case, a CDO. So it's classified as a derivative. When you're buying derivative, such as a stock option, you're not actually buying the underlying stock. You're just buying the contract. Why does it matter? It matters because synthetic CDOs and other derivatives can add a huge amount of leverage to the system without buying or selling the underlying asset. It can amplify the damage if the underlying asset price starts to crash. To give you a reference, in 2006, there were about $1.2 trillion worth of subprime loans. but there were actually more than $5 trillion of investments. How does that make sense? You only have $1.2 trillion of subprime loans. How can there be more than $5 trillion worth of investments in subprime loans? The answer is the extra $4 trillion investments were through derivatives like synthetic CDOs. So what happened in 2008? Now let's go back to this diagram. So everybody knows that in 2008, the housing bubble burst. So what created that housing bubble? And what roles does CDO and synthetic CDO plays in the bubble? As we discussed, when bank loans $1 million to Ray, the bank can choose whether to hold that loan or sell that loan to an investor and get back that $1 million. So if the bank decided to sell that mortgage to an investor and get back that $1 million, the bank can quickly lend that money out again to Ray number 2. And bank can keep just doing that. So why would bank do that? Is that profitable for the banks? Yes, definitely. First of all, it is profitable from a cross-selling point of view. Because when you go to a bank and ask for a mortgage, they'll ask you to open an account and maybe apply for a credit card or maybe open an investment account. Cross-selling is very important for banks. So the mortgage brings a client in and they'll cross-sell other products. So banks want to lend out to as many customers as possible because they want to bring in as many customers as possible so they can cross-sell products and make a profit. Banks can also make money packaging all the mortgages into a CDO and sell the CDO to investors. By banks here, I mean the investment banks. When traders design a product and create a product and sell it to investors, they typically get a commission. This is how investment banks make money. And some banks would hold CDO themselves because the yield to maturity, the expected returns are the CDOs were very attractive. So then everything goes into a loop. When banks get a mortgage, they'll pack it into a CDO and sell it to investors, get the money back, and lend out to more customers, and keep creating new CDOs and sell to more investors. From a bank point of view, you want to lend out to as many customers as possible, so you're going to lower that standard for loan applications, meaning lowering risk management standards or no risk management at all. Because banks understand, as soon as I get the mortgage, I can sell it to an investor in the next minute. What risk do I bear? There's no risk. If there's no risk, I don't need any risk management. I do not need to verify borrower's income. I do not need to verify borrower's occupation, borrower's assets. I don't care. I just want your mortgage. So more and more low quality loans enter this pool. Makes our banking system riskier and riskier every day. Of course, there are other factors such as the affordable housing programs, which encourage everybody to buy a house to achieve their American dream. And also rating agencies such as Standard & Poor's, Fitch, they were paid to rate these products, which I believe was a huge conflict of interest. And besides the CDO, we also have synthetic CDOs. Investors and speculators, they were betting on these CDOs through using derivatives. They want to leverage up. They want to make more returns. They got greedy. So the entire financial industry was messed up. And at the end, the bubble burst. So that's basically what happened before the 2008 financial crisis. I hope you enjoyed this video. Please hit the like and subscribe button and turn on the notification bell. Thank you very much for watching. Peace out.